Well, I'm excited that we have Daniel Schreiber with us here today, CEO and co-founder of Lemonade Insurance. And you and I actually did a talk about, I think it was already 2.5 years ago. So it was definitely time we did one again. So welcome back, Daniel. It's great to talk to you again.
Likewise, good to see you again.
And with this interview, we kind of want to focus on, at least I want to focus on some of the current investor concerns and details sort of coming from the last year or so, but then also always be looking to the future for Lemonade. So first thing I wanted to bring up, and I know a big topic of conversation for investors is the loss ratios. And it seems you're excelling at lower premium products like renters and pet, but the loss ratio of car and home are still struggling. And I think it's been frustrating to investors as well as they see other insurtech companies like Hippo, Root, they point to, and they're making progress in their loss ratios of car and home. So why are the loss ratios of home and car taking longer to improve for Lemonade? And then if you're able to give any detail on this, wonder what timeline might we see more significant improvement in their loss ratios?
Yeah, those are fair questions, and um, I think I can address them all. So let's give it a shot. First of all, you're absolutely right. The assumption at the base of your question is correct. Both car and home have higher loss ratios, higher than we would like to see, and higher than comparatively than pet and renter. So that's absolutely true. Um, I think one other thing implied in your question I'd take issue with, but I'll come back to that in a second. The I think the root cause, although I'll give you a couple of more nuanced causes, the root cause is that these are the products that have suffered the greatest level of severity and are subject to the greatest regulatory scrutiny. So the CPI has impacted,
Mhm.
Americans across their consumption, but some products were hit much worse than others. And home construction costs and car repair costs were disproportionately high. So you saw, inflation rates approach 10% in the US, but inflation for home construction and for car oftentimes exceeded 20%. So you're just seeing two sectors where the severity really spiraled out of control in the last couple of years, 2 or 3 years.
Mhm.
So the kind of secular trends were much less favorable in those lines. And we'll talk about that in Shortex in a minute. But if you look across the industry, you saw shockingly high loss ratios, from the largest and biggest and best insurers in those sectors. So I think this was a macroeconomic trend that was reflected in those lines of business, particularly. And those are the lines because they are basically compulsory products. Car is literally compulsory. Home is virtually compulsory because you can't get a mortgage without it. And it's protecting your most important assets. For good reason, those are also the ones where regulators are the most stringent.
Mhm.
On pet insurance, they scrutinize, but it's not comparable to the level of scrutiny that those two products receive. So I think the combination of the two means that it's just slower to come out. It had a bigger mountain to climb, and it progressed at a bit of a slower pace. And everything that I'm saying is true at an industry-wide level. I'll talk about something a bit more Lemonade specific in a second.
Mhm.
But just staying with that theme, I think that's also enables me to weave in another part of the answer to your question, which is I think we'll get out of it by the end of this year. There may be pockets
Mhm.
that take a little bit longer. I don't want to say that every state will be fully rate adequate, but we're seeing significant rate. We shared about what we got in California for car, which was our largest market and over 50% of rate. A tiny percentage of that has earned in. A tiny percentage of that has earned in.
Mhm.
Um, in California, we just received approval of a major new rating plan for home. It's over 40%, but it's more importantly than just the bulk. It's a whole transformation of how we're going to price homeowners insurance. It's a methodology known as by peril. If you want, we can go into it a bit later.
Mhm.
It's been approved. That will take a while to earn in because we have to shift um, in our customers from the Lemonade Insurance Company to the Metromile Insurance Company. They're both Lemonade Insurance Companies, but we just got the rates approved in a different entity. I won't bore you with the technicalities of why that made sense in California, but
Okay.
we will start seeing next year customers shifting over from one to the other. And it's not only a significantly higher rate, but a significantly more precise rate. It's oftentimes not just about absolute rate, it's about matching rate to risk, and we've been approved to do a major overhaul, which will take time to earn in. But so I guess I'm talking about, on the one hand, big macro trends that brought us here, but also significant tailwinds now as those inflationary pressures collapse and as the approvals and 2 years of effort of filings is coming to fruition, getting approved, and then beginning the implementation and the earn-in. I think there's a lot of reason for optimism, not in Q1, not in Q2. I don't mean that this is something within a matter of months, but we've said all along that during the course of 2024, we think we'll get to rate adequacy. A lot of our growth this year will not be reliant on those products, but we think that in 2025, we'll be able to do a lot better. One other thing that I would add, or maybe a couple of things that I would add. One is we've already improved significantly in these products. So if it seems like these are, troubled products, and to some extent they are, what you're not seeing is just how much improvement we've seen internally. CAR dropped 20 points in 23. It was our biggest improvement across our entire portfolio. So it had a lot of improvement to do, but it improved very, very dramatically. Home dropped 10 points over the year. Insurance companies generally don't improve that much. 10 points year on year is a huge improvement for insurance companies. 20 points is almost unheard of. So while there is still work to do, I think we should all take some solace from the fact that actually a lot of improvement has already happened. The momentum is on the way. There's a ways to go, but there's reason for optimism. So all of that is to say, I think it would be the wrong conclusion to draw that, oh, these guys know how to do pet and renters, they don't know how to do home and car. I think that there's no evidence for that whatsoever. It's just going to take a little bit longer. One other thing, I said I'll kind of take a nitpick one of your assumptions, or take on one of the premises that you said, which is about Hippo and Root. So Root announced excellent results just now. I'm genuinely happy for that. I've always said that our success is not dependent on anybody else's failure, let alone the failure of other insurtech companies. And as investors start seeing that some of the theses underlying the insurtech scene can play out and that these companies can thrive, I think that rising tide raises all ships. That's only goodness. So I don't begrudge them any of their success. Quite the contrary. I think Root in particular is interesting. It's been a pure play car. They've been in telematics-based car insurance 3 times longer than us. Remember, we've been in it just about 2 years. And we only bought Metromile a year and a half ago. We're still quite new to this. They've been at this for 7 years. But I think all of us should draw comfort that there's a big pot of gold at the end of the rainbow. They seem to be doing well. I'm very happy for that. Hippo, I think, is a bit of a different story. They announced, I know their share price surged, but they announced much more checkered results, and they missed most of the things estimates that the street had. And they really let it be known that they're pulling out of homeowners insurance, basically. They're becoming an MGA and a fronting company, and they're changing their business model. Their homeowners book shrank in 2023, and its loss ratio, its net loss ratio was over 250%. The gross loss ratio was also in the 3 digits. And they're projecting a 30% contraction in that business this year. So I don't think they think that that has been a huge turnaround. Quite the contrary, they seem to be jettisoning that business in favor of other places where they seem to be doing better. And I think we'll be just fine on homeowners. Maybe I'll add one more comment. Sorry, it's turning into a longer answer than I had thought.
No, that's great.
I don't think car and home are exactly the same. Our car product has, I won't belabor the point here, but just to say it has structural advantages and massive data flows. Because basically at first approximation, all of our customers have telematics on every time they drive. We get stunning amounts, millions of miles a day of data with very high levels of precision. We have nothing equivalent to that in homeowners. The data feedback loop in homeowners is our slowest product. We don't have devices that give us a continuous stream, and people don't make claims often with homeowners. And the book is smaller than other products like renters. And the combination of all those things just means that we have different cycles at which we move and at which we learn and at which we improve. And some of our products are spinning very, very fast. And therefore, quite aside from the regulatory cycle, our own learning, implementing cycle can go at one kind of pace, revolutions per quarter, whatever it is. And homeowners, we just have to be upfront about, is a slower learning cycle. And because potentially losses can be significant, we're okay progressing at that rate. But I have no doubt homeowners is a sector that we will do very well in over time.
Mm-hmm. That's great. About homeowners specifically, if what's your guys' approach if you have, say you're in a state and you don't have rate adequacy? Would you plan to sort of preemptively cancel policies, pull out of those if you're not sure, or sort of in limbo, or do you try and stick it out and wait until you have these customers already on the book until they're more profitable? Or is it maybe it's a bit of a combination depending, but what's your strategy thinking there?
It's a great question. We have been doing some what's known as non-renewal. So if you look back to our Q2 letter, you'll see that we spoke about it. We spoke about several thousand customers that were non-renewed. That number has grown significantly since then. So we do that. We don't want things on our book that we don't want on our book. And even though canceling policies puts up, downward pressure on ADR, downward pressure on premium per customer, downward pressure on IFP, we don't want premiums on our book that aren't profitable. So conceptually, philosophically, we don't want customers that we don't want. We don't want business that we don't want. And yes, we're happy is the wrong word. We will non-renew customers when we can if we think it's not going to be profitable. A couple of caveats. One is if we think it's just a month away from being profitable, the rates are about to come online and everything's going to be okay, we'll take the hit. We don't want to lose lifetime customers because for the next 3 months they're not going to be profitable. So, that's the first point. The second point is the bar for what is profitable in that context is really anything below 100% loss ratio. You've already got the CAC, and at that point, you just want to make sure that you're not bleeding money, but at the margins, you'd keep that customer. The ongoing cost of keeping customers on the book is marginal. And when the costs associated with claims are in the loss ratio itself, it's the LAE. So I wouldn't, we may want our loss ratio to be in the low 70s, but that does not mean that I would want to terminate customers who are at 87. I wouldn't. They're marginally good. It's not the business that we would ultimately write. It's marginally good. The last thing to bear in mind is that regulation is actually quite restrictive about non-renewing customers. In most states, the criteria for non-renewing customers are the same criteria as not agreeing to write the policy in the first place, which means you have to non-renew based on the same underwriting guidelines you're using for new customers. But we have implemented a methodology. So, for example, in many areas, when renewals come up, we ask people to do a self-assessment of their home. So the app now has capability for self-inspection. You walk around the house, it takes pictures, stuff like that. And we're just getting far more granular at understanding the quality of your building, the materials, the risks involved. And that also opens up to us the ability now to say, hey, if this had come in today with the technology that we have today, with the data that we have today, we would now flag this as something that we would underwrite out and not write. Well, now we're going to non-renew it on the same basis. But all of that has been going on, in short answer to your question.
That's great. You talked about the car product and all the data, millions of streams of data coming in. One thing I wanted to ask you about, if you can speak to it at all, is during the last earnings call, I think it was actually an answer to one of my say questions. You said there are this year several exciting technology advancements that will help with cross-selling and with further refinement of our telemetry and the data science behind that. This will be released in 2024 and will really enable us to accelerate car growth faster in 2025. I don't know if you're able to, are you able to share any hints or insights into what those tech advancements are that you're talking about or were?
Not in detail, no. I will say I am very bullish on car in the medium and long term. I really am. I think we have an amazing team, an extraordinary team with just fabulous product, amazing user experience, and structural advantages in terms of telemetry and the high usage of telemetry that we get. And I think we are already, and with every turning of the cycle, we'll get better and better at being able to have almost X-ray vision into the kind of risk that a person represents. And that will allow us to attract better risks with better prices, and we'll have positive selection, and we will be unattractive to other drivers because we're able to see that, and legacy providers will struggle to see that. So they'll price them as if they're an average, and we'll identify them as worse than average, and therefore they won't find Lemonade attractive. And that's all as it should be. I think the structural stuff is very real. In fact, just an afterthought on home.
Mm-hmm.
Home not only doesn't have that level of technological advantage, but it has a lot of CAT exposure, and that creates a lot of volatility. So even with home, one thing to bear in mind, and this is much less true with car, is that we will get to profitability on homeowners. I'm very confident of that. But we as a company, you as a shareholder, will have to feel some degree of comfort with the fact that even when it's massively profitable on average, it will still be highly volatile. There will be surprises. There will be quarters that will look ugly and that introduce volatility. We don't love volatility.
Mm-hmm.
And therefore, quite aside from just getting to great underwriting, great pricing on homeowners, we do have to continue to be thoughtful about how much of that risk we want to retain ourselves. And in the days of affordable CAT reinsurance, that's one way to deal with it, which is to say we'll write the policy, but we'll resell part of that risk to carriers who like those kind of volatile exposures. We don't like them so much. In the last shareholder letter, we spoke about doing pilots of writing on other carriers' papers for that
Right.
same reason. So I do think home will always have some other aspects to it, because much as we want to satisfy the customer demand, there are aspects of the homeowner's insurance profile that we don't categorically love. Coming back to the car question, there are a lot of exciting things happening, and they're particularly in the area of cross-sell and getting to ever greater precision using the data, but I can't be drawing much more than that. I will say that I think that car insurance for Lemonade will hold its own in 2024. In other words, I think it will grow at more or less the same rate. Although it may yet surprise us, I'm seeing encouraging signs. And I think in 2025, we'll see a bit of a breakout year for car. And because it's a $350 billion marketplace, and we are so infinitesimally small when it comes to it, and we have so many existing customers that we can cross-sell to, I think once we hit our stride there, that will be a huge unlock of value, huge unlock.
That's great. That's great. Going back to the loss ratio, you kind of answered this before, but another question I know some of the investors were discussing after the recent earnings was gross loss ratios excluding CAT. So in the Q4 letter, there was this graph that showed that ratio over time, and it's been relatively flat over the last year. Um, as rate increases, we're coming online. I was thinking you have a little bit more of a downward trend, but maybe it's that maybe rate increases haven't really come online as much as we would have thought they would be by this time. I'm not sure, but and it could be a combination of factors. It was, some of us are talking about this on X or on Twitter, but could you give a bit more of an explanation on why it's
Sure.
been flat over the last year, or help us at least understand your sort of reasoning or thinking behind that?
Sure. I think there are two things at play, one of which I know Tim tweeted about before, so I'll reiterate it. And that is that inflation has been coming down during 2023, and rates have been coming online. But rates have just begun to come online. And what you're seeing here is a crossover, but we're kind of at the point of the crossover where they're more or less equally balanced in 2023.
Mm.
We know the direction that they're each moving in. We're just going to earn in more and more rate. Inflation is going to continue its downward trend. So I think the fact that you're seeing kind of at a stable, the ex-CAT kind of stable, should paradoxically be encouraging, because it's which direction each of those elements are trending.
Mm.
You know that rate is trending up, you know that inflation is trending down, and therefore you know that if we've a flat line suggests that we have beat inflation to the point that it is no longer adversely affecting our loss ratio. And once we've managed to conquer it, now it's a question of kind of quashing it downwards. And I think that there's, again, the macro trends that we're discussing, inflationary trends going down and rates having been approved, continue to be approved and earning in, you can play that movie forward.
Mm-hmm.
There's another thing going on that I thought I'd mention, and I haven't done the hard work of kind of quantifying this, but I thought you'd find this interesting.
Mm-hmm.
There is something counterintuitive, or at least not, maybe not counterintuitive, but not obvious, that happens when you look at things ex CAT. And they disguise something that I want to lay plain to people like you who take interest in the nuances and in the details. So the definition of a CAT is an odd one. In the insurance space, generally speaking, it's a named event, and a named event gets its name once it causes, I think the number is $25 million of insured losses. And then you get a label and a name, and that's a CAT event.
Okay.
And whether it's $25 million and it becomes a CAT, or $24.5 million and it's a non-CAT, sounds a little bit arbitrary, and it is, but that's the way the industry works. And reinsurance agreements are triggered by whether it was a named CAT or not. This is, this has certain importance to people in this space.
Hmm.
Parenthetically, that $25 million number hasn't moved since 1997, if I remember correctly.
Hmm.
So you would expect the number of CATs to go up, even if there was no weather changes, simply by virtue of 25 million doesn't buy you what it did in 1997.
Hmm.
So the depreciation of the dollar over the course of 25 years will result in an exact and opposite growth of CAT events, even if you totally neutralize global warming or any other changes in weather. And there are changes in weather. I'll add one other thing. There'll be massive changes in population densities. So actually the biggest cause of the growth of CAT events over the last few years hasn't been global warming. It's been people moving into areas where humans should not live. Floodplains in Texas, fire zones in California, in part because of to my mind, bad insurance practices, which didn't pass the true cost that people were exposed to onto the customers. So it wasn't doing the social function that it's meant to do, of warning you, hey, this may be not the best place to build a home. So loads of populations have moved into these beautiful areas with massive CAT exposure. Close parentheses. Coming back to my more important central point here, which is the following. Let's do a quick thought experiment. You have a quarter and it has $100 million of attritional losses. Attritional simply meaning non-CAT. Okay, so you've got at an industry level, whatever it is, I'm making up numbers, 100 million. Then you've got a $25 million CAT event on top of that. My numbers aren't going to work very well, but I'll kind of force it to work. So then your total losses are 125, 25 CAT, your ex-CAT losses are 100. Fine. The next quarter, CAT goes down, and you only have $20 million of weather losses. You now have 0 CAT losses because you've just dropped under the threshold of 25 million.
Right.
Your attritional losses have jumped up to 120. Because as soon as you don't have a CAT, all that bad weather that didn't amount to a CAT is now included in your attritional loss ratio. Your actual loss ratio improved, but your ex-CAT loss ratio just got worse.
Right.
So there's a little bit of that going on here as well, which is to say, when you look at us and you see CAT going down and attritional staying flat, really what you're seeing is loss ratio improving, even ex weather. It's just that things. Are you following my thread?
Totally. Yeah.
Okay.
No. Yeah.
So that's the other thing that I think went on last year, which is to say, we were improving across the board. When you take out CAT in quarters with bad CAT, you're taking out all the bad weather. In quarters with less CAT, you're leaving all the weather in the loss ratio.
Exactly. Yeah. Yeah, that makes sense. That's super. Yeah, actually super helpful. So yeah, thank you. I never thought about that, like some of those, and seeing how some of those things are defined. And I mean, I'm sure it's sort of like even how you define what's one weather event and now what's the next one, like
100%. I
did,
thought you'd
oh,
enjoy that.
sometimes these are lumped together and now they cause 75 million, so it's a cat event, but if someone else defined them as they're split four ways and they're less than 20 million each, then none of it's a cat event.
There's a lot of that,
there's a lot
which is
of
why
definition.
there's a lot of that, which is why I think that just looking at that headline and say, oh, XCAT, nothing improved, is probably wrong.
Mhm. Right.
Absolutely things improved, and the
Hmm.
underlying improvement is very real.
Yeah, for sure. I wanted to ask you about guidance and your methodology there, and investors, there'd be a spectrum of opinion on this.
Mhm.
Even where I would fall would be different than other people,
Sure.
but I know it's uh, definitely something that people are a lot of sort of debate around, I would say, from investors. And yeah, a lot of investors feeling that, hey, the guidance given it's overly conservative. It's too conservative, they might say. So it'd be great if you could speak to that some and just say what's your approach, what's your guys' approach with thinking around guidance.
Gladly, and I'm happy to address this. And I was aware of a lot of the concerns pre-announcement. I got a lot of people reaching out to me, kind of begging, please don't sandbag again. And then I know that a lot of people felt let down by guidance and thought, ah, here they are doing it again, kind of thing. So I'm happy to kind of chat that through with you and through you with the broader community. You called us out last year for sandbagging. You did a much better job than I did at predicting what our year would be. I want to delay on that for a second because I mean that quite literally. It's not that we had in our plan the numbers that you put in yours. We did not. We
Mhm.
had in our plan the numbers are very close to what we told investors. Um, I think of sandbagging as you're going to do this and you pretend you're going to do that. We did not. We have a pretty clear picture of how we're going to do this, so we're going to guide to that. Maybe because it's always going to be a range. Maybe you're a little bit conservative within the range, but it's not a there is not a strategy of sandbagging.
Mhm.
What we did find during the course of 2023, to an extraordinary degree, as the year progressed, we kept finding opportunities to improve.
Mhm.
Things went our way, automation went better than we expected, rates came online, a lot of things that we couldn't have predicted. We had ranges of things how they'd come up, and one after the other, they came up at the best end of the range or better. And it combined to a massive outperformance of the year. And it came to a head in Q4 when we just absolutely blew ourselves away, beating
Mhm.
the street by 30% on EPS and halving our losses year on year. And it was just a stunning quarter, as far as I'm concerned, by far best quarter ever. It
Mhm.
was disheartening to see the street respond as they did. And some of this, I think, is to do with the guidance, because it was just we thought a stunningly good quarter. But I guess my point to you is, going into the quarter, going into the year, we did not, notwithstanding the retrospective, they say, oh, paper bag was right all along, they were sandbagging. That's actually not what the methodology.
Mhm.
Nor is it this year. This is a challenging year. It's a
Mhm.
year where we are doubling our growth spend and improving our EBITDA. And
Mhm.
we spoke about this in the letter, but that is tough. If
Mhm.
we're adding 50 million to our cost structure, and yet we're taking out dollars from our EBITDA losses,
Mhm.
um, so we must think that we're going to be able to compensate for an extra $50 million of spend by getting better at everything else.
Mhm.
Re-accelerating growth while improving bottom line is genuinely challenging. Now, I know it produces, during that transition time of you're going out from slowing to accelerating, it can produce what can look a little bit like stagnation. Um,
Mhm.
they did 170 something million EBITDA loss. Now it's 160 something million EBITDA loss. Is that really such a big deal? They grew 20%. Now they're projecting 26%. Is that really a big deal? But what we're doing is we're changing trend lines. Where our growth is now going 18%, 19%, 20%. We predicted 21 now, 26 by the end of the year. We are
Mhm.
moving into an acceleration pathway, and that costs time and money, and it's going to kind of the walking and chewing gum thing can translate into guidance that looks conservative. I don't think it is. I think that we presented guidance that properly conceived, properly understood, is actually quite ambitious, and lays us up very, very well for a spectacular 25 and an even better 26. And we're laying the groundwork for the years to come. But I can tell you honestly, and Tim mentioned this in the call because we were concerned that people would misunderstand and think, oh, we're sandbagging again. We are not.
Mhm.
Properly conceived, this is a challenging year as guided. I want to add another couple of things, if I may.
Mhm.
One is, it was interesting. Our guidance beat every single analyst's estimate on every single parameter. Not by a mile, but we came in ahead of street consensus on everything, on revenue, on top line, EBITDA, or really on everything. And
Mhm.
nevertheless, it was perceived as a disappointment. And I think that's because, particularly with the run up after Root and the share price jumping 30% leader, there was just an expectation of a huge surprise. And we didn't surprise in our guidance. We did surprise in our results, but not in our guidance.
Mhm.
And oftentimes it's kind of buy on the rumor, sell on the news, a lot of interesting dynamics that happen and that result in stock prices doing what they were doing. But in a very deep sense, nobody who was very thoughtful about what we're doing should have been all that surprised. This is consistent with what we've been saying all along at our investor day, at all different opportunities. We've said when we think we're going to be cash flow positive, which is next year, and EBITDA positive, which is the year after. And we're on that path and continuing down that path. There was no surprise, excuse me, certainly no negative surprise as measured against Wall Street analysts or what we have said all along.
Mhm.
The other thing I want to say is the kind of final thing I'll say is the following. I nevertheless have had a real kind of takeaway, if you like, from this quarter. I have been steadfastly, and sometimes to the chagrin of some shareholders, uninterested in the stock price. And I've surprised myself by how sincerely I have been disinterested in the share price. The share price collapse, and friends would find it awkward to talk to me. Daniel, are you okay? My kids asking me, and I was genuinely okay. And the reason I was genuinely okay beyond everything else is that these were huge trends. Our share price was moving up because of anything the company did or didn't do. We beat the street's estimates and our own guidance 16 out of 16 quarters. We were managing the company, not the share price. And the big share moves were a result of COVID and COVID checks and inflation, and what the Feds did had much more impact on our share price than anything that Daniel did. And therefore, I tried not to take credit when the share price shot up, and I try not to accept blame when the share price dropped, because it's obvious to me that these were massive trends, and we were just LMND was moving in the same winds that were turbulently upsetting stocks across the small cap tech growth arena. I felt differently this time. This was a time when clearly the movement was very closely related to the results. It happened on the same day. And it's happened at a time that other stocks in our sector and outside of our sector have been doing well. So it's a time that I couldn't be quite so sanguine about those movements.
Mhm.
And therefore, I have been a lot more reflective about this. Some of this is to do with the guidance, and I tell you honestly that even if I had a do-over, it would be the same guidance because it's an honest to goodness guidance. But I do want to add two things to that.
Mhm.
One is, I would love to blow away our guidance this year as we did last year. Not because we're sandbagging, as I say, we are not, but because we're hungry for growth. We're hungry for outperformance. We are hugely ambitious. We love killing the estimates that we have, and we love throughout the year finding opportunities and improving and investing and figuring things out that we couldn't see at the beginning of the year. And we've done that before. And by God, I hope we do it again this year. I just can't guide to that.
Mhm. Mhm.
But but it would not shock me because we're driven by those things. So the guidance is what we can see, what we can pan, what we can tell the board, what we can tell you. And the reality then is that we are going to fight tooth and nail to always outperform. And if we
Mhm.
succeed, it won't be because we were sandbagging. It was because we're driven to do that. And we figured out a way, and we're scrappy and we're hungry and we're growth oriented.
Mhm.
The other thing I say is that
Mhm.
um, I think I have been neglectful of investor relations. I want to explain myself here. I was in the New York office. We did our earnings call. And that week, I took a series of investor meetings and meetings with different bankers who have worked with Lemonade in the past, took us public, things like that. And when the stock price responded as it did, I was intrigued. I was perturbed. I had a bad day. But beyond that, I wanted to understand it more deeply. And I met with different bankers, and I was like, explain to me, what am I missing here? We just came off the best quarter ever. Profitability is around the corner. We were net cash flow positive the last 6 months at $18 as it was, or $16 or $7, whatever it is. By most measures, I think the share price should be at about 4 or 5 times that today, just by looking at gross profit multiples.
Mhm.
Um, kind
Mhm.
of what's going on, and who has the gumption, who has the balls to short Lemonade at $15? Why are we on this shorted stocks in Wall Street? It just didn't make sense to me. At $150, I understood why people were shorting, but why aren't people scared to short Lemonade? I was asking Goldman Sachs and others that week. And they said to me, Daniel, most of the, I don't know if this is right, but this is what they said. They said, most of the people who are short Lemonade don't know what Lemonade sells. They said they're short Lemonade because the stock is volatile and because they're traders and they make money off of volatility. The product for them isn't insurance. The product is LMND.
Mhm.
And these are the people who are now on your balance sheet, are traders who come in and out, make a quick buck, and are looking at trading volumes and directions and momentum trading. And that's what's driving them. It's not the paper bag and others who are thinking about the long-term value creation. And throughout the life of Lemonade, I have spent a lot of time meeting with the right kind of thoughtful investors. Before the IPO, I worked intensely in hundreds of meetings to get the right kind of shareholders on the book. We wrote it in our founders letter about our long-termism and what kind of investors we want to be aligned with. I spoke about it at length and with passion at our Investor Day 18 months ago. But I haven't spent a lot of time over the last 18 months with those kinds of investors. And we have seen a wholesale, as investors moved out of stocks because of interest rates and into bonds. And as we saw these massive shifts, a lot of money went out of Lemonade, out of the sector.
Mhm.
And what came in its place are the kind of shareholders who, good luck to them, this is what they are interested in, but they're not aligned with what we're trying to achieve.
Mhm.
They're trading the stock as a commodity. They're not long-term growth or value investors, which are the kind that we align with. And
Mhm.
I think I and Tim and others on the team have our work cut out with us in the next few quarters. We've begun this meeting with those kinds of big funds, because when you do have that kind of investor,
Mhm.
um,
Mhm.
when the stock goes down, they buy more. That's kind of the long-term approach. They don't look at the momentum. They say, oh, wow, this is an amazing stock. It's now 10% cheaper. And therefore, they buttress the stock. And you start seeing very different dynamics in the trading. And I think we have a few quarters. I don't want to set expectations of a rapid turnaround, but I think we have a few quarters of work to do with re-engaging with a lot of those large, I'm
Mhm.
not talking now so much about retail, but large investors with the kind of deep pockets and the kind of long-term orientation that once populated our cap table, and today have by and large been replaced by traders.
Mhm. Oh, that's great. Thank you. Thank you. And I want to say too, I meant no disrespect when I used the word sandbagging a year ago, you know.
None
Um,
taken.
and I mean, I'm just a YouTuber who's throwing numbers out there, right, at the wall kind of thing, right? So I understand the difference between somebody who has that kind of freedom to just throw numbers out there versus someone who's responsible to the whole investing world as a whole. And
I
and
do
in
want
my
to
sorry. And I would say, and in my mind, I would prefer a company, skew to being more conservative than skew to being like too optimistic and being really rosy about the future and everyone,
Yeah.
the stock surges and everyone goes crazy and people pile in really quickly and then it doesn't happen and, plummets or something and it really disappoints people. Like, so in my mind,
You're
that's the
saying,
better approach is, how much is that? You try and be accurate, to my mind, it's obvious. You try and be accurate and a little bit conservative, like that's if I was in your shoes, that's what I would be, pushing for. But
I appreciate that. And I think the reason I'm always happy to come on your YouTube channel is because you're not just a guy throwing numbers at a wall. You think about these things deeply, you invest heavily, you do the sleuthing and trying to find different snippets of information, piece together the kind of picture that honestly Wall Street analysts don't have the gumption or the patience or the attention to do. And I think you and others like you are some of the most thoughtful investors and have nothing but respect. And it's also interesting, sometimes it's like that. Sometimes when you're in the details as we are, it's refreshing to have somebody like you come out and say, "Oh, I think they can do much better." And it's humbling to see at the end of the year that you were right and we were wrong. So you were seeing something that we didn't see, and I love that dialogue and I welcome it. And you sell yourself short when you describe yourself the way you did, and that's not the way we regard you.
thank you. Well, appreciate it. Um, let's talk about LTV to CAC because
Sure.
that's something I've been thinking about. And in a way, I kind of I really like this, even thinking about this or explaining the sort of, what's the elevator pitch of lemonade? If I'm talking to someone about it or thinking about it, you can sort of, it's an easy way to financially understand, sort of quantify, really quantify, hey,
Yeah.
what's the value proposition here, or what's the thesis here? Because so you'd said in the past, I think it's been said that LTV to CAC, lifetime value to customer acquisition costs, is around 3. But then in the Q3 letter, you said, hey, in recent quarters, we've seen LTV to CAC of 4 and higher. And
Yeah.
then I was doing some of my own math, um, and confirming those numbers more like, I think, it depends sort of what do you assume for lifetime loss ratio.
Right.
But, for closer to 5 kind of range, like just like you had said there. But, and my own thinking too is, hey, if home comes online, car comes online, these become really like leading excellent products with, as a whole, obviously home's going to have fluctuations, but as a whole, you talk about sort of the lifetime loss ratio for customers in those streams as a whole. It's I mean, just playing with numbers, but I was getting LTV to CACs that are higher than 5, even 5 to 10 kind of range. Can you give any insight into what that sort of potential ratio could be in a market where all products have adequate pricing?
Yeah. So I do think there's some welcome tailwinds to the LTV. Leave the CAC for a second,
Hmm.
which is to say that rates are coming online and our modeling does not assume rate increases. So that's upside to the model.
Mm.
Um, Cross-sell is getting better and our model does not assume continuous improvement. It assumes status quo. So there are reasons to think that things will get better in terms of lifetime value. I think cross-sell and rates are huge.
Mm.
As car becomes something that we want to sell more of, I think much of your thesis passes the sniff test. There's reason to believe that there is significant upside to lifetime values. I also think there is a halo effect of the brand. The more people know about Lemonade, the more people know about Lemonade, and therefore
Hmm.
conversion gets better, retention gets better, trust increases. I think time spent in market and the number of millions of customers that we have all kind of starts to trickle down and may help with CAC and with retention and with cross-sell as more and more people know that we have more products. We're still in the early innings and there's a lot of education to do to our customers. And I think time is on our side in that regard. And I think you're right that those are all tailwinds that should all improve things. One of the headwinds is the more you invest on CAC, there are two schools of thought here. So one says that at scale you can do a lot more than you can do that's small, but I think at least in part, when you have the kind of methodologies that we have, where you're prioritizing spend with some precision based on LTV modeling,
Mm-hmm.
then at least in theory, every dollar you spend has diminishing returns.
Mm-hmm.
Your most efficient dollar is the first one you spent, and then the second one is marginally less profitable, and you keep going. In a perfect world, every
Mm-hmm.
marginal dollar has a slightly less good return. Two things to take away from that. One is that just as you increase growth spending, as we're doing this year, you should see some of that LTV or to CAC ratio come down. That will be a headwind.
Mm-hmm.
You will get the most profitable customers first, and then it will keep going down. So that's one thing to bear in mind, and that will be a counter pressure. But I think there's a bigger picture that it's worth asking. In my mind, an LTV to CAC of 5 to 10 using your numbers is not desirable. I think it means that we're not growing fast enough. I definitely want a customer at LTV to CAC of 5. But let's say I've exhausted all the LTV to 5 customers. Now there's an LTV to CAC of 4.9. Do I want them? You betcha. If I can invest $1, I want 4.9 back. And as you
Mm-hmm.
go down that curve, you get to LTV to CAC of 3. Do you want them? Absolutely, you want them. Bring them on. If I can spend $1 and get $3 back, and remember, our $3 is already discounted for the time value of money, so
Mm-hmm.
it's already factored in there. So yeah, I'll spend $1 and get $3 back in today's dollars. Absolutely. Do you want two? Yeah, I want two. If I can double my money, I'll double my money. And I think that logic holds true all the way down the curve until LTV to CAC equals 1. Even a customer of 1.1, you want them. You absolutely
Mm-hmm.
want them.
Mm-hmm.
So I think maybe you have some at 10. Your worst customer should be an LTV to CAC of 1 in theory. And then the question is, where's the average? And that's really a distribution question. So we
Mm-hmm.
already have customer LTV to CAC of 30. Some of our channels are amazing. But the question is, how far down do you want to keep going? And I put it to you, they want to keep going all the way down till LTV to CAC of 1.
Mm-hmm.
That makes sense?
Yep, totally. Yeah,
Okay.
that's perfect. What about the customer acquisition cost? I've I've at least I've read it's kind of hard to calculate, but I've read from some studies that a lot of legacy insurers would be more like $500 to $900 per customer they acquire. My own calculations for you guys, it's more like $100 to $140 per customer. I think it was Maya in an interview actually threw out the number $100. I feel like it was one point or sort of a roughly the acquisition cost. Are you able to share what your average acquisition cost has been or
Yeah.
typically has been?
So first of all, I think your estimates are about right. They are ballpark correct. I'll add a level of kind of nuance, which is more expensive policies are more expensive to acquire. There's
Hmm.
more competition for car, and people will spend more for car, etc. So
Hmm.
what your numbers are right on based on the current mix of products that we're selling.
Right.
But I think a more helpful, perhaps, way to think about this, because this kind of scales up and down across our different products, is that we typically see um, CAC of about 1/3 of the first year's premiums.
Hmm.
And that's roughly true if a customer is going to have $100 policy with us or a $2,000 policy with us.
Hmm.
So, as a rule of thumb, I think you can assume that we are spending roughly 1/3 of year one premiums.
Yeah. So if your premium per customer is 300 and something, then yeah, you're probably, in that 100-ish range. But obviously if you scale up more into car and home and you have really great products there and there's a lot of factors that can kind of push it one way
Yeah,
or the
yeah.
other. But
The AdWord buy on Google for renters insurance and for car insurance, just one is a lot more expensive than the other because
exactly.
the sale is a much bigger sale. So I
Yeah.
think per policy, you should assume that we are roughly rule of, as I say, rough justice, about a 3-to-1 ratio.
Yeah, yeah. That's great. Um, okay, talk about top line growth. So Investor Day, you talked about 20%, annual growth. You had some models there. So I think or maybe there's a 12% model too. I'm trying to remember, but
There
about
was, yeah.
20. And then this year for 2024 guidance was about 20, I think it was about 24 or 25% growth. Um, People like me that are been watching sort of all the details, we've noticed like the smallest little like hints, we like the synthetic agents blog post. I
Yeah,
remember somebody pointed this out on Twitter and we're talking about it. Said there was a line that said this holds true in modeling not for 12 or 20% growth, but also for growth in the 30s and 40s too. And of course, history would, you have much faster growth in previous years would indicate, I mean, that could be possible just
yeah.
again. So, are you able to give, I mean, obviously can't give guidance here, you're not doing that, but are you able to give indication of whether we would see higher growth in the 30 to 40% range? And I ask this because I think some investors sort of just assume, oh, well, they're going to grow 20%, maybe 25% kind of forever now. That's sort of the plan. That's maybe what the assumption they make. And I'm not sure if that is the plan or if there's variability in that. So,
Sure. And we did in Investor Day say that 20 to 25% was kind of an optimal burn rate, if you like. And then you're quite right in I wrote the synthetic agent blog post, so I remember putting in there that 30, 40, or even 50, maybe, I can't remember exactly, but yes, the spirit of what you're saying is absolutely correct. Let's break it apart a little bit. I don't know what 2025 will look like, so I'm not giving guidance for that. I'm really not.
hmm
I have pointed out even earlier on this call and elsewhere that, and we even drew a picture of this in our latest letter, which is we're on a growth curve. It's not merely that we're growing faster than we did, but we're accelerating. So Q3 was 18% of last year, Q4 was 20%, Q1 this year we've guided to 21%. We haven't yet guided to Q2 and Q3, but we have guided to Q4, which is 26%. And you can more or less straight line that. It looks like a fairly steady acceleration of growth. I'm very hopeful that that doesn't stop in Q1 2025 and that we continue to see that. I'm not guiding to that, but I'm sharing my aspirations with you.
hmm
Um, One of the things to bear in mind as you're thinking through the synthetic agents versus what we said at Investor Day is the following kind of trade-off. And we're not at this juncture yet, but maybe I'll sensitize you to some things because they may come up at some point. If you're only interested in cash flow, then we can grow at 30, 40, and 50% because of the synthetic agents. Because we've solved the cash flow gap. That's really what that message is all about. And we will not sell policies at a loss. So we do need home and car to get to where we need them to get. But once we've got that, you could start seeing some very substantial growth rates without us having to suffer any kind of negative cash flow. And probably it would be the very best thing to do for the business in the medium to long term, because you'll just be layering on top those cohorts, which your models show, eventually will yield spectacular returns. So bring them on. So long as they're good cohorts, layer them, layer them, layer them, layer them, layer them. The more the merrier, and the enterprise value will increase. The place where that is not true is gap accounting. So it may be that synthetic agents has solved the cash flow. I think it has. I think it's an amazing deal, which most investors haven't fully wrapped their heads around. I think it's transformative. It's really an amazing deal. But it doesn't solve gap accounting. And if you're interested not in the cash flow part of our financial statement, but in the P&L side, you won't like what that looks like. Because it will mean taking somebody else's money,
hmm
spending it profitably, but taking the hit in the P&L right there and then.
hmm
So if you're optimizing for, as I say, for cash flow, absolutely accelerate and keep accelerating so long as loss ratios and LTVs are good. If
hmm
you're managing to EBITDA, you will
hmm
find that constraining you. So at the moment, I guess we have two constraints in place at the moment. One is home and car aren't where we need them to be, and those are growth engines that would have to kick in to get to the kind of growth levels that you're asking about. I think
Mm-hmm.
in 2025 they start kicking in.
Mm-hmm.
And the second thing is EBITDA at that point you'll face a crossroads where optimizing for EBITDA takes you one path and optimizing for cash flow takes you down another path. We haven't been at that crossroads now. We wouldn't grow faster anyway because we don't yet have all the products in all the places that we need them. But when we reach that crossroads, we'll have to cross it.
Mm-hmm.
Does that make sense?
That's great. No, that's really, really great. Um, yeah, we're almost at 7:30. You're okay to do another 10 minutes, 10, 15 minutes? That kind of
Let's see what we get done.
okay.
Yeah.
Okay. See what we can do. Okay. I'm going to shift a little bit. I wanted to ask you about Israeli tech culture, where you guys are based. So I recently read Ty Sagalow's book. I think he's one of your first employees or first employee. His book, The Making of Lemonade, and he did tell one little story in there about his first trip to Israel. And something that came through was your own love for Israel, its culture and people. He talked about, hey, just like touring around with you a little bit and some of that. Um, so could you give us a flavor of what the Israeli tech startup culture is like? And is there any, what is special about it or advantageous about it for Lemonade?
Sure. Ty's very dear, and he was our kind of first head of insurance, and he taught us the ropes when we didn't have a first clue what we were doing. And you're bring back a smile or bring back memories from some great years that we spent together. The remnants of my English accent tell you that I'm from London. But yes, my wife and I made a home in Israel. Although I have to say that I'm a bit of a citizen of the world, um, wandering Jew, whatever um, label you want, which is to say, in addition to being in England and in Israel, I've spent 3 different times in my life in Silicon Valley. And kind of Silicon Valley over the years became more of a home away from home than London did. The accent remained, but Palo Alto and Silicon Valley is really where I spent many years, happy years, and career intensive years. So I'm very familiar with the Israeli tech scene. I'm very familiar with the Silicon Valley scene. These are two of the most vibrant tech scenes in the world. Um, the NASDAQ has, I think, the number 2 country in the world on the NASDAQ after America and Silicon Valley is Israel. And Israel's a
Mm-hmm.
tiny, tiny country. That tells you something. There
Mm-hmm.
is something similar about the two.
Mm-hmm.
And they're both highly entrepreneurial. They are both very ambitious cultures, big ideas. The startup culture is deeply enmeshed in local culture, if you like. That's true in Silicon Valley, definitely true in Israel. Israel became known as the startup nation. It's a big kind of part of the local culture. It's what a lot of people aspire to do. So there's a lot of similarities. Both are very engineering centric, very deep tech, and good universities producing amazing people with top engineering qualifications. So I think at first approximation, I would say that what makes Israel an exciting tech hub is the same kind of stuff that Silicon Valley has and that not that many places in the world has.
Mm-hmm.
Amazing universities, amazing graduates, a very supportive culture, a lot of venture capital, and by this point, a lot of older folks who have been through it and can mentor some of the up and coming entrepreneurs. Israel has a few areas of difference with Silicon Valley, although I think overwhelmingly they're similar. One is that no Israeli high-tech company thinks about the Israeli market.
Mm-hmm.
From day one, there is no domestic market that you're interested in. The 9 million citizens of the state of Israel are not what you start up a company for. So Israeli startups have a global orientation and export orientation, where Silicon Valley companies usually do not. The rest of the world is usually an afterthought, if that. They
Mm-hmm.
tend to be in that sense, much more parochial because they live in the largest market in the world. So they're less interested in Asian markets and European markets and others. And the
Mm,
speed with which we launch in Germany and France and the UK, etc.,
mhm,
is probably a reflection of that difference, and probably would not have happened had we been a more Silicon Valley oriented kind of business. And the other thing
see,
is,
yeah.
Israel lives in a very different neighborhood than Silicon Valley geopolitically, and it has a a people's army. Everybody serves in the army when they're some of their most formative years. Age 18, they go into the army, and most of the army is made up of these 18-year-olds. There are obviously some older folks, but it's incredible, extraordinary to see within a year or two in the army what levels of responsibility these young men and women bear,
Mm,
and therefore they can reach. It's kind of a massively accelerated career path, if you like, of quickly learning, gaining skills, managing people, shouldering responsibilities that are truly
mm,
monumental. That in civilian life, it might take you 20 or 30 years to get that level of a size of a team and level of responsibility. And there you are, age 21, doing that kind of thing. So I think
mm,
we do have the benefit of that as well. People come out of those 2 or 3 years in the military, and sometimes people stay on for another couple of years voluntarily
mm,
with a level of intensity, a work ethic, and a skill set in terms of management and action-oriented work, etc., that it's harder to get when you go through a more conventional kind of life cycle.
mhm. That's great. No, that's thank you. Yeah, thank you for that. That's awesome. Something can I ask? It's a little more personal question, but I think it could be helpful because I'm sure some. I think I kind of know the answer, but I think some investors would. It would be a criticism or critique or thought that people might think I'll throw out there, and it's for they might say, oh, you for Daniel and Shai, both of you, and say, hey, you guys did really good and when the market was at peak euphoria and able to sell shares, and people might say, hey, these guys can just put their feet up and coast now, and if lemonade runs to the ground and whatever gets bought out or so whatever, the very sort of cynical sort of side of a person might think that, right? And they might say, oh, what is their motivation now? What's their drive now? So I'm wondering if you can speak to that, your own, and I mean, Shai's is it may be similar, so you can comment for him, or just leave it to your own motivation if that's better. But what's your motivation seeing the long-term
Sure.
success of Lemonade?
I think Shai and I are very much of the same mind, but I'll talk in the singular because these are personal questions.
Hmm.
Um, I understand the question. I understand the concern. It is entirely unfounded. It's not unreasonable. It just happens to be unfactual. Um, I think very few entrepreneurs are primarily driven by money.
Hmm.
Strange as that sounds, because successful entrepreneurs make good money.
Hmm.
And I am incredibly grateful to Lemonade for providing for me and for my family and for giving me profound financial independence. And I don't belittle that for a second. And it certainly was one of the currencies in which I was hoping to get paid in founding Lemonade, but only one of them.
Hmm.
And absolutely, by that measure, I could have stopped working many years ago. Um, you know, Shai
Hmm.
as well. But we've both had reasonable successes before we ever came to founding Lemonade.
Hmm.
Um, we did not found the company in pursuit of riches. Um, though, as I say, I'm not dismissive of them. I don't mean to downplay them, but that
Hmm.
isn't the primary motivation of most founders, most entrepreneurs.
Hmm.
Um, Even if you're worried that it is that I'm all about the dollar, by far, my largest position in the world is Lemonade, and by far the biggest determinant of how wealthy I will be a year from now, or 5 years from now, 10 years from now, is Lemonade. And by far, it doesn't come close to anything else that I own by far. So it's not
Hmm.
that I'm have no financial incentive tied up to the success of Lemonade. I own millions of shares, and the outcomes will be transformational and by far. But
Hmm.
honestly, that's not why I get out of bed in the morning.
Hmm.
I do have. I hope this doesn't sound gauche, but I have more money than I need. Um, I live a fairly modest lifestyle, and my wife and I and our kids, we're very happy, and we're not into yachts, and we're not into private jets. And if I had another $300 million, I still wouldn't have a yacht or a private jet. It's just not the lifestyle that we seek for ourselves. So, um, you know, money isn't a major motivator, wasn't in the past and isn't in the present and won't be in the future. And if I was looking to just coast, I'd have left Lemonade years ago or never founded it.
Hmm.
Um, what does get me out of bed in the morning, the reason I'm so excited about Lemonade, is for other forms of gratification, psychic gratification, financial as well, as I say, but not predominantly. I
Hmm.
love big, hairy, audacious challenges. I love the David and Goliath kind of dynamic that we are experiencing. I love reinventing industries. I love building companies. I love building teams. I love building brands. I love the competitive dynamic of wanting to win and build and grow and create value. I love satisfied customers. I love talking to interesting people. I love working with amazing people. I love technology. I am thrilled by technology. I find it exhilarating and interesting and so fast moving. And I am I am deeply rewarded by seeing people who believed in us rewarded. When I see employees of ours who've been with us from day one, and worked so hard, make good and make money because they believed in us and we believed in them, and together we built something. And the same thing is true of my investors.
Hmm.
Far from being indifferent, one of the currencies in which I get paid, if you like, is seeing people like you, who have been so interested and diligent and hardworking, and who have, for rational reason, but who have, through hard work and analysis, come to a conclusion that this is a vector that you believe in.
Hmm.
I will feel very good about myself when you are proven right. Strange as that may sound, that's one of the things that motivates me. It really, really is.
Hmm.
So a lack of motivation is not an issue. Having made money is not demotivating for me. People who want me to make more money if Lemonade goes well, I will make more money when Lemonade goes well. But there
Hmm.
are other things that motivate me even more. And Lemonade success is highly motivating for me because of all those different currencies in which I will get compensated.
Hmm. That's really great. No, thank you for that. I mean, that was sort of the answer I was expecting, but it's great to just hear you articulate it yourself. And yeah, I think a lot of people, kind of retail investor world, have they misunderstand some of those motivations, or they think it's just like, oh, it's all about the dollars, and they're just doing this only to cash in more money, or they're just sucking this on. It's like they don't seem to fundamentally understand, some of the core things of life. It's like, these guys have way more money than they really need. They could go buy the yacht and the private plane and put their feet up, but that's not going to be a very fulfilling life, and they're
Yeah,
smart enough to know that. So
yeah.
yeah, it's great to hear that. We can do one more question. I don't even know if this is a good question or not, but do you guys have a mission statement? Does Lemonade? I don't even
We
know.
do. We do. We don't tend to engrave it on our walls or anything like that. But if you look in our S1, which was the public filing around our IPO, the book that we put out then. So it's front and center there at the kind of very beginning, which is that, and over the years it's undergone some rewording, but what we wrote there is that our mission is to harness technology and social impact to be the world's most loved insurance company.
Hmm,
And perhaps that's a good note on which to end
great.
today's chat. It was wonderful to talk to you, Paperback. Thank you so much. And anytime you have um, you've aggregated enough questions that you think you or others would enjoy, just reach out and I'll be happy to spend time again.
That'd be great. Thank you so much for your time, Daniel. And yeah, I'd love to come visit Israel someday, in your offices there. I think someday it'll happen. I'm not sure when, but
You'd be more than welcome. Love to
that
show you around.
that would be awesome. Okay, well, have a great rest of your day, and we'll
Thank
talk
you.
again soon.
You too. Bye for now.